Welcome to Mastering Market Trends. In this video, we'll journey together to the depths of technical analysis. Recognizing trends, bullish and bearish, can have a significant impact on your strategies. So whether it's delving into the different types of trends or unraveling the mysteries of support and resistance, by the end of this video, you will have a foundational grasp on these crucial indicators. So together, let's unlock the power of technical analysis.
If you look at a chart, you will notice that prices move constantly up and down. Your first question may be, why does it move up? What forces are behind the financial instrument that makes prices go higher? The answer is simple. Prices move up when there is more demand than supply. Basically, what that means is that there are more buyers than sellers. Conversely, prices move down when there is more supply than there is demand. In other words, there are more sellers than buyers. What happens when the balance between supply and demand changes, you may ask? Well, at that point, tops and bottoms are formed. And so what is a trend? A trend is a period in which price moves persistently in one direction. That move is generally not in a straight line, but rather irregular movements resembling a series of successive waves with peaks and troughs. Each of these extremes form what is known as support and resistance levels. Support is the name given to lows, the troughs of the waves where the market stops falling and turns around to start rallying. Resistance is the peaks of the waves where price finds it difficult to continue moving higher and turns back down. So support and resistance levels define the trend. All support levels need to hold to maintain the run of higher lows, and all resistance levels need to break to sustain a series of higher highs. Contrary to what most people think, markets don't only move up or down, they also move sideways. Therefore, trend has three directions: up, down, and sideways. An uptrend would be defined as a series of higher peaks and troughs. A downtrend would be a series of declining peaks and troughs. And a sideways trend would be a series of horizontal peaks and troughs with overlapping waves. Obviously, the most logical strategy for a trader or investor will be to buy when he or she identifies an uptrend, to sell the rallies in a downtrend, and to do nothing when the market moves sideways. And this brings us to the three premises on which the technical approach is based. Since the inception of markets and trading, trends have existed. Even going back to the 1600s, trends can be found. Technical analysis is all about spotting trend and trying to trade on the right side of trends, buying things that go up in price and selling things that go down in price. So it should be easy to understand the importance of identifying trends. In fact, the three tenets of technical analysis are all related to trend. First, everything is in the price, which is set by supply and demand. Remember those support and resistance levels that we just discussed? Second, markets move in trends and trend persists. And third, market action is repetitive, or history repeats itself. Let's see what each one of these tenets mean. First, everything is in the price. This is likely the most important aspect of technical analysis. The reason is simple. We believe that anything that could possibly affect price is actually reflected in the price. Therefore, it follows that the study of price is all we need to be successful at trading or investing. That means that all hopes fears, and knowledge, including informed and reasonable expectations, are already factored in the price. In other words, it doesn't matter what the reasons behind an excess in demand may be, it means that prices should rise. If prices fall, then the fundamentals must be bearish due to supply exceeding demand. And just to make sure you understand 100% of what we are discussing here, let's clarify two terms that we will be using constantly.
Hello, it's Sidi again. Just a quick pause for something incredible. If you are serious about mastering technical analysis, then don't miss out on our Technical Analysis Mastery 114-day course. It is an absolute transformative journey for any trader. Interested? Then click on the link below for further details. Also, if this lesson has added any value to your trading knowledge, let us know in the comments below and share some love by clicking on the thumbs up button. More importantly, don't miss out on any future expert insights and subscribe to our channel. Let's continue.
Bullish and bearish. Traders who buy first, going long in anticipation of a rising market, are termed bullish. Traders who sell first, going short in anticipation of a falling market, are termed bearish. The reason for those two terms is simple. When a bull attacks its victim, it tosses it up in the air. When a bear attacks its victim, it knocks it down into the ground. Hence, bulls profit when prices rise because they hold long positions. Bears profit when prices fall because they hold short positions. As technicians, we understand there are reasons why markets go up and down. We just don't concern ourselves with those reasons and simply study price action in the charts. The charts will reflect the bullish or bearish psychology of the marketplace. The second tenet says a market moves in trends and trends persist. We already know that trend is a directional movement of price and that it persists. We only need to look at a chart to notice that while prices move up and down, sometimes prices continuously rise more than they fall, and we have already learned that that is called an uptrend. The next thing to know is that just as in Newton's first law of motion, a trend in motion is more likely to continue than to reverse. And finally, the last tenet states that history repeats itself. The key to understanding the future lies in study of the past. While markets can and do indeed change, they are moved by people, and human psychology does not change. Therefore, the behavior of market participants tends to be the same and produce chart patterns that have been identified and categorized for more than 100 years. Therefore, technical analysis is the study of past price action for the purpose of identifying future price trends. In short, trend analysis attempts to discover what the trend is and if or when the trend is changing. The problem is that at any given time, there are a number of different trends interacting with one another. A trend in 1 minute chart may be down with a series of lower lows and lower highs, but at the same time, the same market seen from an hourly chart will show an uptrend, and the downtrend we see in the 1 minute chart is only a correction within the main uptrend. To avoid confusion, technicians limit trend classification to 3: major, lasting over 6 months, intermediate, with a duration of 3 weeks to 6 months, and near-term trend, defined as anything less than 3 weeks. Your success as analyst and trader depends entirely upon your ability to correctly identify the trend. Even if your setups are all based on indicators and oscillators, you still need to be able to identify the trend before you can apply any of your indicators with consistency. In fact, the only purpose of all the tools offered by technical analysis, including indicators, patterns, support and resistance, etc., is to measure the trend of a market in order to be able to take part in it. Some technicians even define technical analysis as the art of identifying the trend and trend changes at the earliest stages possible. To be more clear, the very first step towards a successful trading career is to be able to identify the trend. And the very first step before taking a trade is also to identify the trend. The easiest and most effective way to identify the trend is by using a trend line.